Hello, and thank you for joining us. I'm Meek Brooks with Freedom Infinite Growth Investments, FIG Investments for short, and welcome to our first webinar, where today the topic of our focus is going to be discussing what exactly is the market. And so, what our agenda is going to consist of is that we're going to detail what is the market, and then we're going to tie that into understanding what is an actual stock market. We're also going to go ahead and touch on who are the key players within the actual stock market, as well as how do I actually look at the performance of the stock market on a grander scale using indices. And then what we'll wrap it up with is actually detailing the stock market cycles, along with touching on the behavioral psychology piece that's also critical. That tends to be a part that not many always touch on. And some of us as investors can forget that psychology plays a huge role in investing. So that will be the primary focus of this webinar here. And so I'll go ahead and get us kicked off with starting off with what is a market? So when you think of a market, there are many, many different types of markets that you can have. When you looking at this first image, this is an image of a home. And when you think about what takes place, you can buy or you can sell a home. And so that then becomes the housing market. You have your housing market. You can go to a fish market if you want to just buy just fish, or you can even go to a supermarket where you can buy or sell fruits, vegetables, and things of that nature as well. So the concept of what is a market is really just a place where people are able to meet, and you have one party that's actually going to offer to sell you a good or negotiate on the prices there, and another party that's actually going to buy the good. And there's negotiation there as well. When you think about in terms of supply and demand, when supply is really high, we may see prices start to come down. So your buyer may have advantages there versus when demand is very high, then we may see prices actually go up, in which your seller then is more so influenced in the negotiation there. So that's the concept of what it looks like to actually have an established market. It all entails just buying and selling goods, a place where people are actually able to meet, come together, and exchange um, money or exchange goods for something in return. That's the concept of a market. So let's put that into perspective of an actual stock market. When you think of the stock market, it's made up of millions and millions of people. And what takes place there is, again, that same negotiation where if I wanted to negotiate the price of what the apple costs, we're doing that same exact thing within the stock market. We're negotiating a price that we either want to buy a stock at or a price that we want to sell a stock at, in which there are two main U.S. markets that we tend to focus in on, which are the most well recognized within the U.S., and one of them being the NASDAQ. And with the NASDAQ, this is one that was actually established in 1971. And it's like I said, a very popular exchange that we see a lot of our domestic U.S. stocks actually traded on. Um, and then you also have your New York Stock Exchange, which is also known as the NICE. This is actually the older of the two when it comes to the different marketplaces that we have for buying and selling investments. The New York Stock Exchange is, again, one that's very well recognized. So let's put this into perspective. The NASDAQ and the NICE is that supermarket for us. It is that place where we're going to actually be able to buy or sell our product. Or our good. And what is our good when we think about it in terms of the stock market? The good is stocks. And so when you think of what is a stock really is just a security that represents ownership share in a company. So what that means is that a company is able to actually go public on the market, in which we call that an initial public offering, where they present their company to be established on the market. And as an investor, I have the opportunity now to buy shares of this company to give me ownership so that I can also go with the flow of either gaining or taking some losses as that stock continues to go day by day. But again, a stock is just simply a way of a company a company's way of actually raising money to continue to grow their investment. And they're raising money by doing what? Going to the market and saying, hey, here's a portion of my company that you can buy. By you buying a share, you now own a part of that company as well. So definitely keep that into consideration when you think about the NASDAQ and the NYSE. That is the big overlining marketplace. And like I said, you have stocks that you sell on the marketplace. Here's an example of a stock. And here you have Apple. And again, the stock itself is Apple. And what I can do is I have the ability to buy shares in Apple. Right now, as you can see at the top of this presentation, where you see the actual name of the company and the ticker, the AAPL is the ticker, the symbol that represents that company on the market. You can see which marketplace it's actually trading on. The NAS represents the NASDAQ. So there you have that understanding of what marketplace am I actually buying Apple from? I'm buying it from the NASDAQ. That's how you could parallel that conversation there. And again, you also see on this slide where it shows Apple's actual market cap, which is going to be important there. A market cap just truly represents the value of the outstanding shares that a company has in relation to the price. So if the price is 176.56 right now, and it looks like it doesn't show the outstanding shares here, but let's say there were 1 million outstanding shares, you would actually multiply that to determine what the actual market cap is on that company there. So it's just what's the total value of the shares that's out there that people can actually purchase when you think of it that in that terms. So next what I'm going to tie this to is actually who are the key players in the market. When you think about the key players in the market, you have your long-term investors, in which these are going to include your investors that believe that over time, their money will make money. And I'm talking years. We're talking 5-10 years. These are investors where I want to buy Amazon early on. Amazon went public back in the 90s. I got in Amazon right there, and I wanted to hold that for a long time because I had confidence that this stock was going to do well and that this company was going to do well. And so if you think about that in terms of today, where Amazon is at, anyone that actually owned it way back then, those are some pretty well-off long-term investors at this point. Another way of thinking about a long-term investor is individuals that may have a 401k. What are you doing? You're saving to be able to have retirement income to live off of in the future. And your 401k is just diversified in different types of investments there. And so your next type of trader that you come across is your short-term traders. And what they're looking to do is they're looking to generate profits by consistently trading. So an example here will be your day traders. Those are individuals where they're buying, they'll buy shares of a stock for one price, and then they'll sell it pretty quick. They're not holding this for a year. They may only hold it for a couple hours. They may hold it for a few days, but they're actually going to go ahead and buy and sell it to take a much shorter profit, but to pretty much try to stack those profits over time to give you at the same pace somewhat of what the long-term investor may see at the long-term space. So your next type of player that's involved in the stock market is going to be your portfolio manager. And that's exactly how it sounds. That's going to be individuals or companies that's actually going to manage funds for others. So you're basically paying someone to say, hey, develop me a portfolio, you manage it, you make me money. That's what your portfolio manager is doing. They're going to do all of the work for you and put you into those investments, and you're going to pay them to actually do that. And then next up, we have what's called the investment bankers. A little bit different here with the investment bankers. Their focus is more so to help clients raise money. So previously, we talked about how companies actually join the market, and they do that by doing an initial public offering. And so you may see these type of companies work with different investment bankers to get their company on the market, or you may see companies that's looking to do a merger or an acquisition. They'll go to an investment banker to assist with those type of services and have capital raised within the market for their company. And when I say a merger, basically that's when we have two companies that's coming together. We're joining to become one company. And an example of a merger I want to say out there right now, you have T-Mobile and Sprint when they're talking about coming together to join together as one company. That's a merger. Whereas with an acquisition, that's where one company is actually buying out another company. Slightly different there. Now, your last two players are actually two of the most important players in the market, and that's going to be your brokers and your market makers. Now, your broker, when you think of a broker, here's where you need to think of companies such as like E-Trade. What does E-Trade do for you? They're basically facilitating the sell or facilitating the transaction of a buyer or a seller. So let's say I want to go and I want to buy Apple. I'm going to go to my broker, which is E-Trade, and say, hey, buy me this number of shares of Apple and I want to pay this price. So what my brokers is going to do is they're going to actually go out there and try to fulfill that transaction for me. They're going to look for a seller that's selling it for the price that I'm looking for. They're going to look that the seller has the number of shares that I'm looking for. And that's what the broker is going to do. They're going to actually execute that transaction for you and buy you those shares or actually sell you those shares. And then you have your market maker. Now, your market maker, they're actually typically going to be your larger investment firms or financial institutions, because what they do is they actually create liquidity within the market. So when you go and you're looking to try to buy something and E-Trade is not able to, they don't have it in their portfolio, they may go out and look for another market maker who's holding a large amount of shares within this particular company that's able to create liquidity and say, okay, here we are, I can actually get those shares from a market maker versus within the actual market because it's unavailable. So your market makers play a very pivotal role within the market because, like I said, what they're focused on doing is creating that liquidity. Now, let's talk a little bit about actually measuring the stock market performance. And how we do that is we use different indices. And we use indices for multiple reasons. One of them, as an investor, you can use indices as a way to actually benchmark the performance of your investments. So a lot of times what we do as FIG is we'll look at the S&P 500 to say, how is our performance in comparison to how the S&P is actually performing? And what we strive to do is actually outperform the S&P. And so just to give you a little bit more details about the indices that you see listed here, we'll kick it off with the Dow Jones. Oh, and before I dive into that, let me also just call out that in addition to looking at it to measure the performance of your portfolio, one of the most critical pieces that it's used for is as a leading indicator to actually see how is the overall market performing and what does this mean for our economy. So that's the critical takeaway that I want you to make sure that you walk away with understanding. Use these as a way of gauging how the overall market is performing in relation to the economy. Excuse me. So the first up we have is the Dow Jones Industrial Average, also known as the DJIA. And basically, this is an index that's only tracking 30 large cap companies. And these are companies that's publicly owned and traded on the New York Stock Exchange, which again is the NYSE. And they may also be companies traded on the NASDAQ. And so basically what it is an average of how are those 30 companies performing. So it's not as all encompassing because again, we're only looking at 30 companies at a higher level. And these are companies that are large cap companies. Remember, I was telling you about the market cap. Large cap companies, they have over $1 billion for a market cap. And so then the next one is actually it's very similar to the Dow Jones, but it's actually a little bit more inclusive, is the S&P 500. This one is focusing on large cap stocks, and it's looking at actually 500 of them. So when you look at 500 versus 30, already you know that you're going to have a better picture of what you're looking at for the market holistically. So that's why a lot of people look at the S&P 500 as an index to actually gauge their performance as well as the market performance. And you also have the NASDAQ 100, which is specific to the NASDAQ market only. So they're taking the top 100 companies, and these are going to be your largest domestic and international companies, excluding financial companies, and they're analyzing the performance of those 100 stocks. Again, this is only giving you a scale of how the NASDAQ is performing because it does not include companies that may be traded on the NYSE exchange, that New York Stock Exchange. And then just lastly, we have that Russell 2000, which this one is a bit different than the first three that I've named here, because this one actually focuses in on small cap stocks. And the importance of that here is, again, you got the bigger picture looking at some of those other indexes, but how are smaller companies performing? How are our small businesses doing? And a lot of times mutual funds and ETFs can be tied to some of those smaller companies because of the way that they're actually developed and formulated. So they actually look at that to understand what's the performance, and they try to at times tie back to different indexes. They may tie back to the Russell 2000 and try to meet that same performance level, or they may tie back to the S&P, or they may tie back to the Dow Jones. Again, these are a great way to just understand how the market is performing in relation to also how are your personal investments performing. So that gives you the background of what the indexes are used for. And at this time, I'm going to transition it to my partner, which is the Vice President of FIG Investments, Mek, and he's going to go ahead and detail a bit for us the business cycles.
All right. Thank you, Neek. So we want to pull up here and show a diagram of the stock market cycles. So Nick basically went over and covered what is the stock market, right? What are those indexes and those key players that all play a part in the stock market? But also something also interesting to look at is what is actually the stock market cycle? And you may say, okay, so what's the importance here? Why should we basically understand what the stock market cycle is? So you might hear this popular adage about buy low, sell high, but no one actually really explains, exactly when you should actually buy something and actually sell it. So this understanding the market cycles provides you with better hindsight, insight, and foresight on when you should increase putting your hard-earned money into the stock market when the odds are tilted in your favor, which would be buying low, and then take money off the table or out of the market and increase your defensiveness when odds are out of your favor, which would be selling high. When people invest in the stock market, they do so because they think investments will increase in value over the periods of months and years that are ahead to come in the future. All successful and intelligent investors devise strategies based on the market cycle, what the business conditions look like in the months and the years ahead, and what that indicates on the odds and probabilities of success when they're adding or withdrawing money from their stock portfolios. By being a passive investor who just buys and holds and not understands the stock market cycle, you miss the opportunities to tilt the odds and probabilities of investing successfully in your favor when conditions in the market indicate you should be buying low and being more aggressive, which would be charging like a bull, or maybe sell high, be more defensive, wait, and hibernate like a bear. There's another popular adage that says you can't time the markets. However, when one is passive and they just buy and hold as an investor, another adage says that people buy and hope is not a strategy. They often buy when the market is dangerously high and then sell when the market is low, doing the opposite of buying low and selling high as they watch their investments decrease in value over the periods of months and years. That is definitely timing the market to do the opposite or contrary to what you should actually do to be successful, and those investors either achieve just average or below average and inferior results. So bottom line, it's important to understand the market cycles, as all investors who do so are more successful than the average investor, in which they tilt the odds in their favor and their investment portfolios outperform the assigned market benchmarks, such as the ones Nick mentioned with the Dow, S&P, or the NASDAQ. So let's talk about here now the economic and business cycles, right? So to define what a cycle is, you can say the cycle is a repeatable natural phenomenon found both in nature, social, economic, and political activity amongst human beings all around the planet Earth. In nature, we have seasonal cycles in which the Earth goes from cold weather in the winter to spring, and in summer, where it's more warm and hot weather. And then it falls back to winter based off the Earth's rotational cycle around the sun. In politics, we have, the US has basically a 2 and a 4 year political seasonal cycle where we elect a US president, state governors, senators, House of Representative members, in which it goes from campaign season to election season, and then the president being in office. And if he's fortunate or she's fortunate to get reelected, it turns into a lame duck season. Again, it goes from a cold to a warm, hot based climate, and this is all based off of social interaction. Then we also have an economic cycle that's based off of all human activity involved in the production, distribution, and consumption of goods and services, which moves between periods of an economic boom when things are kind of hot and into an economic bust when things kind of get cold. So the stock market is a reflection and projection of the markets based off of both the underlying activities and influences of political, economic, and natural cycles. You see here on the left, top left, we have a picture which shows the outside of the US Federal Reserve building where the US Central Bank is housed. They control monetary policy, which influences the economy and has an impact on business industries. They are normally anti-cyclical, in which they try to prevent the economy from overheating, where bubbles would occur. And then they also try to prevent these bubbles from, or these booms from turning into busts. And then they also try to stimulate the economy when it gets cold and then turn these busts in the economy back into booms. On the right side, there's a picture of the US Capitol building, which holds the US Congress and the House of Representatives and the US Senate. The US Congress, they manage the fiscal policy in which they raise revenue from the government to cover for government expenditures by raising taxes, which can also be a headwind against the economy. And then they lower taxes, which can be as a tailwind, and it pushes to stimulate the economy. So looking at these economic and business cycles, we're not exactly trying to predict the future of what global, macro, political, economic may look like, but we only kind of want to know what the current economic conditions are and what it could possibly mean for the fundamentals on the industries, businesses, and their derived stock security prices. An intelligent strategy behind what value investors do is they seek to take advantage of the discrepancies that occur between the current stock price and what the actual value of a business is based off of fundamental criteria they analyze and assess with these industries and these businesses. So if you look at the chart, you can see where we have an economic cycle and it kind of swings in a symmetry, just like a pendulum. And it goes from these periods of a boom, and then they also, swing to the other side where it can also be a bust. So normally you can't have a bust without there first being an economic boom. It can be years before economic boom occurs, and then all of a sudden, out of nowhere and really fast, we have these busts that just occurs kind of like a speeding freight train, just something on a real fast down movement. So you often hear in the news that the market is on a bull run, and then you'll also hear that the market is in a bear territory. We'll kind of cover this a little more in the next slide, but both the bull and the bear market cycles are derived from economic and political activity, which influences the business environment and therefore influences the stock prices of those businesses. Another popular adage you might hear is that a rising tide raises all boats. And that can also be applied towards the economy, where economic tides rising also raise the business boats' profitability, and then therefore the stock prices also rise in accordance. So next we want to cover what is the psychology behind the market cycles. So again, we talked about the pendulum swinging, right? You have these economic and business cycles in which it creates these asset bubbles in the market, in which when these great economic conditions occur, everyone is kind of crowding into the market, and it's basically a fever pitch for everyone wanting to buy stocks. There's a popular saying that there's a fear of missing out, the FOMO. And this can be where you see things start to swing, and basically these asset prices go into a bubble. And then these bubbles can bust, and then people move into another extreme state where it swings to fear, and people don't want to buy anything as they fear further losses. You can kind of think back to around the housing and credit bubble from the 2006 to 2009 period, when we experienced the mania in the markets of everyone buying housing, and then housing prices raising up real fast. And then all of a sudden, these prices collapse, and then foreclosures occurred a lot. There's a great story to tell about Benjamin Graham, who was Warren Buffett's professor in Columbia. This is a gentleman who was around in the early 1900s, and he wrote a book called The Intelligent Investor. In The Intelligent Investor, and also according to Warren Buffett when he took his class, he said Benjamin Graham would tell a story about Mr. Market. So he referred to the stock market as Mr. Market, and he says that Mr. Market is a manic depressive individual. There's days when he's really manic, and there's days when he's really depressed. On the days that he's manic, basically he's going to quote to you all these outrageous prices for these stocks that may be way over what they actually value. And then the next day he can be really depressed, and he'll quote to you a price for a stock that is extremely low, where it's actually below what the actual value of that business is. There's also another legendary investor by the name of Sir John Templeton, who is credited with the adage of saying, invest at the point of maximum pessimism, which also builds off of what Benjamin Graham taught. So when you look at the chart and you start from the top left, you see those periods of an economic boom. And in the stock market, this is also the point of maximum optimism. And it's also the point of greatest financial risk. This is when market prices are really high, it's at a peak, and there's a fear of missing out, or FOMO's full effect. This is euphoria, and there's great downside risk from a market crash. So here's where you want to be more defensive and not buy any longer, but you probably want to be selling. And then also the market can start to move in a downturn as you move more to the right and it gets to the trough area. And then the market moves from a psychological state of fear down into panic, anger, and then finally depression. And this is at the point of maximum pessimism that you should be aggressive and you should be looking to buy those companies that are basically now at a price that's below the value. Warren Buffett has also quipped that you should be greedy when others are afraid and be afraid when others are greedy. Or this is the Wall Street saying that simplifies it to say buy the fear and sell the greed. So let's look next at a chart of the actual Dow Jones Industrial Average and now apply the bull and the bear market cycles. So on this slide here, you can look and it basically depicts a bull market run. So it starts from the year of 2009 when the last recession occurred. And then you can see on the right side, we're here in the current 2020 period. So back on March 19th, 2009, the Dow Jones recorded a market low of 6,507. And at this recorded low price, they then basically tracked the upward movement in which all the way up to February 2020, the market returned a 351% return. And this is a great bull market run over this almost 11-year period. And then on February 12, 2020, the Dow Jones recorded its last known high of 29,551. And from that point, it went on to decline 20% down to the price of 23,550 for almost a 6,000 point drop. This 20% decline from the last marked high is known as the bear market. Anytime the market declines 20%, it gets into a bear market territory and starts a bear market cycle. When the market basically declines from a 10% high, when the market declines from a 10% low from its last recorded high, that basically denotes a market correction. So essentially, we're now at this point in a bear market, and we wanted to see and monitor just how low it will go, and then basically start to see when the markets may swing back into which it goes into a bull market. And then we know that these are areas where we want to basically start getting more aggressive in buying and trying to find those stocks that are priced below their value. And this here concludes our presentation. This is only a basic overview of the stock market, its cycles, and the behavior market, or the behavioral psychology of the markets. But we'd like to ask you to please consider joining up with us at Freedom Infinite Growth Investments so you can continue to learn more about how to apply all these different concepts. And we have more intermediate to advanced information that builds on these things where you can learn, grow, and develop your financial investment intelligence and literacy with us. Thank you very much for joining.